Hello, everyone. Hello, hello, hello. Hello, everyone. It's a special live session today. I'm Anthony, and another one is Davey from here. So it's so weird today that for many of the audience here because Rita is on leave. So we are the only two speakers for today. So today our session is what can Davey share with us?
Okay, so I've got to unmute myself. Good morning, everyone. Good afternoon or good evening, depends on where you are. My name is Davey Leung, and joining today will be Anthony opposite to me. So we are going to run this as a genuine conversation rather than two separate talks. So you hear us spill on each other and occasionally push back because that is usually how these questions get worked out in a real deal room. Okay. So let me start with something recent. On the 4th of December 2025, in Hong Kong High Court sanctions the scheme of arrangement for Country Garden Holdings in Cantonese Big Bayou. Okay, so the largest offshore properties workout in Hong Kong history, cutting roughly US 11.6 billions of debt. And on the 16th of February 2026, a few months ago, the winding up petition hanging over the scheme since mid-2024 was dismissed. So one property developer facing exactly the same sector headwinds as every other large mainland Chinese property group. And it came through while so many peers did not. So for HR professionals here, before anything else, restructuring, what does restructuring mean? So restructuring simply means a business owning more than it can currently pay, and someone now has to decide who's get paid, in what order, and whether the business can keep operating whilst that gets sorted out. So no courtroom required, and just a gap between what's owed and what is available, and a clock is already running. Okay, so here is the thesis for the next 50 minutes. So restructuring does not create weaknesses in an organization. So it activates the weaknesses that we have. So it activates the weakness that were already there, and those weaknesses show up first in the people who can decide and who genuinely owns the outcome, and whether the bench can execute once the playbook runs out. So Anthony, so you are usually the one calling in exactly the moment that test goes live, right? So when does it actually begin? Okay, he will be joining very soon. So from my opinion, so much earlier than most people assume. That's what surprises clients every time. By the time when we are called in, the organization usually needs to act months earlier. It's not today. So usually clients call us into the company and explain a lot of my problems, what they can see currently, and why and what is the consequences. And deadline is, for example, tomorrow, or maybe a week later, or maybe next Monday. So sometimes the organization usually needs to act a month earlier, sometimes maybe a year earlier. So so Anthony, what do you think? What do you think about like this entire situation?
Yes, thanks, Davey, for the introduction. So Actually, for restructuring, we almost think that restructuring begins before court proceedings. Why? Because they're deterioration signals. So there are normally 5 stages on the company's status, which is working healthy or unhealthy. So I would actually take it one step earlier than the court process. By the time everyone is talking about maybe a scheme of arrangement, liquidations, and negotiation with creditors or formal restructuring, quite a lot happened before the court proceedings already. The first signs are often much less dramatic. Management information starts coming in late. So the information could not provide any judgment for you to make your judgment. Cash decision became increasingly tight, reactive. You could not actively proceed with your projects. Maybe a supplier changes term and then tighten your cash flow. Then your landlord start chasing the rent. One important employee suddenly seems to be hiding everything together. So decision that I used to take one day now may take 3 days or even a week, or even when you are email or telephone to ask the colleague to get you the information, they are only hesitated to give you the information. Okay, individually, none of these things necessarily means the business is in restructuring. It's even before restructuring, because there are some issues already, but together they can tell you something important. The organization is beginning to lose their operability. Maybe they still have the capability, they still have the staff, they still have the knowledge, but you can see they are losing their operability. This is very important. I mean something quite practical. Can the organization still see what is happening, make a decision, assign somebody to act, or actually carry the decision forward? Sometimes it's a plenty of information in the organization. Finance might know one part, operation might know another part, human resources know the pressure in the building, especially when they are scanning about the employee feeling. So they are actually between the frontier and the mid office. Those frontier people are hearing things from customer and supplier. There are many signals and noise out there. The problem is that nobody is trying to join in all the information together. Maybe somebody has some signal, but they could not join in together to see the big picture. That for me is an early restructuring signal. So I would not wait until somebody said, okay, we might have an insolvency problem. Can you please help us? I would ask much earlier, what is our present state? What is the trajectory going? Which means what are we planning to go? And are we in a normal management arrangement that are still capable of responding quickly enough? So because the deterioration is moving faster than expected normally, and then you will find the human resources, especially maybe the critical staff, they might choose to leave, or in other way, the cash position is getting very tight. So David, what do you think then?
Yeah, I'm seeing the very similar thing when I go see those clients. So the real beginning at the moment is the ordinary management stops from producing an adequate response. So we talk to management, and they've got no idea what they are doing, and then at the same time, they thought, okay, nobody can quite say who has the authority to approve the significant payment. I will be sharing some cases later on to this real case. I will mask the name. I won't tell you who is the client. So the cash position is quite unclear for most of the company, and commitments are being made today, and that may not survive next quarter. So a lot of management they try to commit something that they can clearly see it is not the results, for example, in the coming quarter. But they used to promise some kind of like promises in the company. So the business may be still trading for the coming few months, and the staff may be still working, but the system is quietly stopping copying. Okay. So what's interesting is that by the point, people inside the organization usually already sense something is wrong. So imagine you're working in a company, and Some creditors sometimes call the accounting department and ask for money, chase for money, and someone sends a letter to your letterbox, and then when you open the letter, your total amount due to this company has been like 47 days or 75 days, and you better settle the whole amount within next week, otherwise the case will be escalated to next steps. So you can smell something in the company. So they don't just have a chance to say, but they've tried nothing that should be happening very soon. So because calm water is the best disguised, a governance problem ever gets. Okay, so when the business is trading, when the shops are full, even when the suppliers are being paid slowly rather than on time. Okay, so let me repeat. So even when the suppliers are being paid slowly rather than on time, every structural weaknesses stays invisible. So when what we say in Cantonese is business as usual. So you don't feel the pain, you don't feel the irregularity behind the company. An underpaid person carrying all the institutional knowledge looks like a loyal asset. So imagine in your company who has been working in your company for more than 15 or 20 years. So it looks like he or she is a loyal asset to the company. It's not a liability, but from our point of view, the saw has two sides of very sharp edges. So a director withdrawing cash without a minute looks like an entrepreneur. Is not a governance risk, right? So you have seen a lot of company with not a lot of staff. They ask the accounting department, can you issue a check of like 50 or 500,000 Hong Kong dollar because I want to buy something. So we've got no question asking why, because you are only the staff and you have been working in the company for more than 15, 20 years and you are going to retire very soon. So most HR systems and the talent reviews are calibrated for calm water. So they measure the performance in the condition that exists, not resilience in conditions that they don't exist yet. So the weaknesses accumulate quickly until the water gets through, right? So Anthony, so what do you think when you finally walk into the company? What does stabilization actually protect first?
Okay, thanks, Davey. So I would say stabilization first protect. I think the first mindset is that stabilization is not going to protect everything. Okay, the first thing is have to make a decision making here. What we would like to protect. The first thing actually is not to solve everything. The first thing is to stabilize. And I think this distinction matters. And when the organization is deteriorating or going downwards, the immediate objective is to stop it from losing the ability to choose. Actually, ability to choose what? Your decision. For example, normally you have to protect the liquidity, but also you have to protect the information you need to make decision, protect the records, protect the critical operations, or protect the people carrying essential knowledge. Okay, you have to protect the key suppliers, customers, and the lenders relationship. And very importantly, clarify who can actually decide what. Because in the crisis, if every small operational decision will have to go back to one founder or one senior executive, that create a very important dependency issue. And then actually, if this important person was in accident or left the firm without any notice, the situation will worsen very quickly. So stabilization is really mean creating enough control and enough breathing space to answer the next question properly. So what is still next available and what path could we actually go? This is why I see stabilization as the first phase of the restructuring, not the final solution. So when you head back to Davies, so your first case is useful here because it shows what happened and the people carrying the consequences and the people controlling the decision do not necessarily see the situation in the same way.
Okay, thank you, Anthony. So I will use three lenses to demonstrate what is happening here. And the first one is we really land through a real case. So we want to have a real case to demonstrate what we mean by like first lens is ownership. So if you can find the paper, the first is ownership. So whether the responsibility for the enterprise generously extends to everyone whose life is tied to it. So that person is living, is working, is living with the decision. So only to the people who shares the register. So let me repeat. So my first lens is ownership. So whether the responsibility for the enterprise generously extend to everyone whose life is tied to it, or only to the people on the share register and shareholder register. Okay. So I've got my own test. So on the day the major decision is announced, do the people who must live with it believe it is theirs to make succeed, or something handed to them to defend against? Okay, so I've got a case study called HeFlux, an industrial darling of Singapore, a founder-led water treatment company. So if you stay in Singapore, you know HeFlux is a very big company. So they held up for years as a national champion success story. Around 34,000 of the retail investors held the stocks and treated almost as a very big community with structured updates and a consistent narrative of stability. So they always deliver the message: we are very stable, we are okay, we are doing great, you're doing fine. So what's happened? In May 2018, HeFlux filed a court-supervised debt restructuring. So you'll be surprised why, right? So facing approximately of the Singapore dollar of 2.8 billion in claims. So Singapore dollar 2.8 billion in claims. That's huge money. So in 2020, the rescue attempt, a partial acquisition by Utico FZC, collapsed when the retail investor base refused the terms. So situation is there is a main guy and another 34,000 of the shareholders, and they reject the terms of the partial acquisition. So the Singapore High Court eventually ordered the liquidations of the company, and reports indicate the retail investors face losses of up to 90% of their capital. So retirees and all the ordinary shareholders who has trusted the story for years. So it's a very sad story. So running the ownership lens. So remember my first lens is ownership. So running the ownership lens, the choice between the rescue and liquidation sets entirely with the board and a narrow advisor group. So we are talking about like 34,000 people's decisions is now forced into a few people and maybe a small advisor group. So the 34,000 of the people, most exposed people, has no seat until the liquidation has already converged. Okay, so the people who own the consequences never own the decision. They own the loss, they own the consequences, but they never own the decision. So at the Utico rescue's collapse is approved. The deal mechanized never integrate with one veto points that actually matters. So mirror the question for this room. So all in this room, like we are in this room. So who are the equivalents of the HeFlux retail investors in your organization? So people who lives are genuinely tied to your survival, with no formal seat in how you are governed. Okay, so Anthony, so when ownership like this case is misaligned, what does walking into that stabilization actually feels like?
Okay, thank you, Davey. So we are talking about the ownership misalignment here. Actually, is relating to human capital governance and another layer, human risk. Okay, for me, the important issue is not who are the shareholders or who own the shares. in a restructuring, we normally look at three groups of staff or employee or stakeholders. Actually, who knows, who decides, and who carry the consequences. So when those three groups become disconnected, which means maybe the upper management, they could not exercise strategy, and the execution part, they have no idea what the upper management and the boss are doing. There's a risk over here. And then this is actually the human risk. You can have somebody in finance who see the problem but does not have the authority to challenge. You might have some senior management with the authority, but without the proper information coming from the front line. You can have employee receiving angry call from the creditors and customers for not paying their bills, but no one has told them what to do or what to escalate. So you could see there are three layers here, from the governance, strategy, and execution. They all have their issues. And the most important part is they are disconnected. And you can have one long-serving employee carrying the knowledge that the whole organization depends on, but no backups or limited backups, no proper authority, and no succession plan. And then there's no other staff who could have the same knowledge that this employee has. This is where the human capital governance becomes very more than HR matters. The issue is not simply whether you have enough people. It is whether people have the right capability, authority, information, and escalation route to carry the institution or the company through the stress. And that is also what I mean by human risk. Human risk is not people are the problem. Human risk appear when capability, authority, pressure, incentive, behavior, or dependency affect the organization's ability to make a good decision and execute them properly. So under restructuring pressure, I would like to know who has the responsibility but no authority, who has knowledge but no backup, who had bad news but they could not safely escalate. So these are the issues we are looking for. Those are the governance issues, and they are materiality effect where the stabilization could work. So even if you could solve the ownership question, you still have to execute. I think that leads directly into David's, your case, the Country Garden case.
Yeah, thank you, Anthony. So, I think back to Anthony's logic, and also the stabilization. Like, how do we feel the stabilization when we walk into the company? Later on, sharing Country Garden case. So, what feels like when we talk about stabilization, it's like a ship where everyone agrees something is wrong, but nobody agrees whose job it is to turn the wheel. So, who drive the boat? And some of the people who should be steering have already quietly moved forward or moved towards the lifeboat. So when you ask someone, okay, can you drive the boat? But then what they are thinking in their mind is, where's the exit? I want to exit. I want to get towards the lifeboat. I don't want to drive the boat anymore. So the specific problem about ownership misalignment creates about the information flow. The people holding most of the critical information, and how bad the cash position really is. Which creditors are closest to acting? So who will be chasing, like tomorrow when I report back to the office at 9 a.m. when I have my coffee, and people line up outside my door and ask for money. Often people who have never had a genuine stake or genuine ownership in the outcome. So for example, so when you send a letter to the company, ask for money, who are you sending to? Mostly accountant. You won't send the letter direct to the boss and ask for money. Most of the time, the boss will ask you, okay, can you send an email to my accounting department, and because they are handling my cash, blah blah blah. So those people who have never had a genuine stacks in the outcome, so they have exposed to the downside without ownership of the solution. So even though if they pay for the outstanding, they don't own the solution. They are just like solve the problem. So they hold back rather than volunteer what they know, and stabilization runs entirely based on information in this case. So you can't protect decision capacity if the information is feeding, it is incomplete or filtered around in the entire system. So what's interesting is it sits between the first line and the second lines, what I call the second lens. It's about the execution discipline. So the first one was ownership, and the second one was execution discipline. So the muscle memory of the middle management to act under the time pressure, and in a consequence, nobody rehearsed. Okay, so I've got a test again. So in the first 30 days, does the bench output holds near its normal median, or collapse because it was never ever built for the steady state? Okay, so Country Garden, BigY. Some sector, the same sector headwinds as Evergrande. So if you were in my last presentation like a month ago, I was talking about Evergrande. The same regulatory environment is also happening in China. But the restructuring negotiated across the multiple offshore notes classes simultaneously, holding a structural line on a 5-year deferral. It's like 5-year deferral rather than a haircut of the debt. And the timetable run from a proposal to the effective date in roughly only 12 months. Okay, so 5 years of deferral rather than haircut, and timeline within 12 months. So that doesn't happen without a bench built for it in advance. Okay, so Treasury, finance, investor relationships, and also the offshore council sustaining for a year of disclosure heavy work without visible collapse. So imagine if you survive in a company with the significance of that, not only in your own country but also in outside other countries, the company still survive in the 12 months, and also within the 12 months there are like super heavy load of the information disclosure, and everyone are having the back lens to look at, okay, what are you guys doing? Okay, so main shareholders vehicles also absorb real equity pain, so the operating platform could also continue. So what is the HR lesson here? That bench has to be built before the pressure arrives. And also the Country Garden had done that work already. So most of his peers did not. So if I ask Anthony for the same question from the visibility side, viability side, what does a genuinely ready bench actually looks like in your case study, in your experience?
So I think we have to distinguish a financially viable plan from the institution that is capable of executing the plan. Maybe I'm going to use institution or company interchangeable here, so that to make you more easy to understand. You can build a spreadsheet showing the numbers work. So, but everyone knows there might be a bias over here because we would like the company to perform well. So you have an inherent bias here, okay? But that doesn't mean the company doesn't have the capability to do it, okay? But before, what we have to judge is that if the company has the capability to get over there. For me, viability has several layers. First, obviously, the financial question is there a credible future cash position? Can the obligation be dealt with? Okay, is the proposed structure fundable? Okay, for fundable, that's a very important part because that means are we able to make enough money, okay, or collecting our receivable back to pay off to the debtors. But there's one important issue here. We can store the payment for the suppliers or even the government. But I'm warning you not to. But another point is we could not store the payroll to our staff. That will create a very critical issue that the staff might choose to leave the firm immediately. Okay, so let me go back to the question. Okay, does the organization actually have the capability to execute the future we are modeling? Okay, and capability is more than having good people. That's why I think staff or human resources are very important in taking control of the part. An individual may be very competent, but institutionally, the capability means that the organization or the company can combine people, knowledge, system, authority, resources, and the relationship all together and deliver a good outcome repeatedly and reliably. That is what we can see the sustainability here. During restructuring, that becomes very viable. Okay, who can produce reliable cash information quickly, as long as because the vendor, the suppliers, or even your customer will call you from time to time every day. So you have to know the cash position quickly. Okay, who understand the legal entity structures, who own the credit communications, who coordinate the legal, finance, okay, operation and HR, which we use the GRC concept here, which is a capability models. So can you combine these capabilities together to make the company working? Who can make a decision when two advisors disagree? We have two advisors, which might means, okay, there might be the COO, another might be the CFO. They could see the same issue differently. Can we resolve the issue? And who has the enough management bandwidth to run the business while the restructuring at the same time? And what happens if one critical person leaves tomorrow? This is what I circle back, what I previously talked. This is what I mean also by the ready bench. This is not just succession planning in the traditional HR sense. And this is having enough institutional depth so the business does not depend on one individual for the knowledge, one individual for the authority, and one individual for the network. This is very important here. Okay. Specialists remain specialists. What is specialist? In a company, there are many specialists. For me or Davey, we might be a finance specialist. Okay. For Rita and some professional staff, they might be specialized in human capital governance. The restructuring advisors, okay, maybe from the outsider on the restructuring advice. The lawyer on the legal conclusion. Okay, which we mean the specialist. And then what we see here is specialists actually could create depth in the knowledge background and the knowledge domain. But the specialization or the specialty itself is silos. What we can do is how can we break the silos and making all the information together to form a decision making here. So it's technically sound restructuring can still fail if the company itself cannot carry it. So I think, David, your third case that the problem is much tangible because it's much smaller because small business actually is not that small in Hong Kong or in other Southeast Asia. So I think it's a very good sharing to our audience here why the dependency become very personal here.
Okay, thank you. So I will share the third case, and I suspect that this case is closer to home for this room than either of the first two because the size is rather like smaller. I won't say it is very small, but it's smaller. But then smaller in terms of compared to the Heathlands and also to the Country Garden. So it is not a listed company, no high court judgment, and no billions of dollars. Right. So what makes it the most important case for an HR audience is that every failure in it sits inside the HR own territory. Right. So it is about job design, compensation, escalation path design, and conflict of interest governance. So this is a real case, and I won't tell you the name from our own consulting practice. So before I tell you about the case, I've got one quick question for Anthony. Just give me 1 or 2 words. When you walk into the business and the very first question you ask has no answer at all. What does that actually tell you? One or two words.
Okay, that means knowledge, authority, evidence stop connecting. Okay, maybe we have found that the founders know one part. Okay, the finance know one part, and the frontline staff know another part. But no one could make a concrete decision making based on any information available. So before trying to redesign the whole business, we have to know what is actually happening at that case.
Okay, so hold that thought, because that's exactly what we found, right? So picture a group of more than 25 food and beverage companies across Hong Kong. They do Chinese, they do Western, and also they do fusion restaurants. And in some of the highest traffic and highest rent location in the city. So they found over 20 years ago, by a husband and wife from a single restaurant. Okay, so that's very normal operation, like path work in Hong Kong. So more than 200 people working across the group. There is no holding company at all above any of these. So a web of over 25 entirely separate companies with no consolidation balance sheet and no single entity able to negotiate across all of them at once. They've got different closing dates. They've got different year-end dates. For example, March, June. I've seen like August and also in December. Okay, so the creditor exposed when we were engaged approximately about 200 million Hong Kong dollar, roughly 2 億 in Hong Kong. So at the center is a head of accounts. So over 20 years with the group. So the accountants has been working for the group for over 20 years. No degree, no accounting degree, no CPA, no ICCA, no ACA, no whatever, like the professionals qualification. No professionals qualification and well paid below her real scope of responsibility. So she knows every transactions across the 25 companies because she personally enters most of them, like one by one, invoice by invoice, receipts by receipts in Excel and Microsoft Excel. So that's a legendary system built on 1960s. Okay, so it's kind of very old system. So when a director asks for cash, she books it as a director's loan. So no board minutes has ever authorized these withdrawals, and nobody ever give her the authority to say no, because the director is also the boss and also the founders, and she is only a working class, is an employee of the company. But then she has been working for the company for over 20 years. So since the immediate supervisor is the ultimate owner, so guess what? What's the purpose of the cash withdrawal? Will be seen entrepreneur or investment. So don't ask. I ask for money and then you just sign a check for me. Okay. When things is fine, it's fine. So here's where it turns structurally dangerous. Neither the long-standing external auditor or the head of accounts ever post the audit adjustment and ties the audit adjustment entries back to the live accounting system. So imagine if you got the accounting management accounts and also the audited accounts. So when you're on board, you want to know about the opening balance and the closing balance. We should be tied back to the accounting system. It's not the case in here. So a mutual and also a sustained omission by both parties, year after year, and a genuine breach of duty of care under HKICP standard on both sides. So the auditors is on breach and also the accountants is on breach. All right, it's a serious problem. So prior year adjustment or maybe like last year adjustment were in state rolled directly into the following year opening balance by the auditors. It's not by the accountants. So outside companies they've got their own books. At the same time, the auditors has their own like internal books for the clients. So they also help to incorporate the several new entries and prepare management accounts, meaning one relationship was simultaneously incorporation agent, management accounts, and personal friend of the founder as well. So independent auditor. So we are talking about independent auditor. Auditors imply independence. So the live books and also the audited statement do not reconcile. Big problem. We also found a tangle of current account running in both directions. So you know what is current, directors' current account, right? If you are accountants or if you know something about accounting, so you know the current accounts is an account that I owe you money and then you pay and then I owe you again. So there is a pool of the amount due to and due from. So this is about the current accounts. So current accounts running in both directions with the same related parties. So I was talking about 25 parties, 25 companies, and company A owes company B, and company C repay for company B in the company A expense. So it's very complicated. We are talking about 25 companies of the current accounts. So debit balance in some entities and credit balance to the others, with intercompany fees and interest flow book, like interest expense, interest incomes floating like in and out from lots of companies. Even with the technologies today, we've got AI. I asked AI, can you analyze the entire case? And AI give me a feedback. Sorry, I cannot analyze the case because it's too complicated and there are lots of duplication. So this is the answer to us. So the detail I most want you to visit with, some properties were sold before the banks later agree to interest-only relief for 24 months. So if you heard about in Hong Kong, there are lots of the government guaranteed or maybe the banks guaranteed loan to the company in the COVID time. It's called SFGS, or maybe the governance guarantee fund scheme that most of the company in Hong Kong in the Hong Kong market is currently enjoying. All right. So that cash inflow was a genuine window to regularize the documentation. So when you get cash, it's the best time to document all of the inflow and outflow, all right? But it was never used. The cash moved again and through the director's current account. So imagine if you are a bank and you borrow 2 million to one of the company, and the main aim for the loan was to sustain your operational expenditure. But then the fund went to the director's current account because director's current account is obviously a rubbish bin. You put all the ins and outs in the rubbish bin. So you've got 2 million and then it went to the current account. It's a big problem. Undocumented and also the interest-only relief that followed become a fatal illustration of safety, masking the problem of 2 more years. Okay, so when the runway ends, imagine in the airport, when the runway is ended, every creditors arrive at once. So everyone knock on your door, everyone lining up outside of your office. So of the few children of the owner, the older son and the daughter both step away. They have decided, okay, this is not my business. I'm going to work my own professional outside, whether it is a doctor, it's a lawyer. I'm not going to come back to the family business. It was only the younger son who saw the cliff edge and brought us in. So Anthony, so we are in the same case that we consulted the clients. So when you walk into the company in day one, where do you even start the case? Where do you even seize all the question you asked?
No, I want to say something first because it's not a special case. It's quite a typical case that we encounter for so many years. Though the same pattern happens since we joined the industry. So I think this pattern you can see maybe from other jurisdictions as well. So, but we would like to draw the attention here that why the stabilization is important here. So actually, when we are entering any kind of this client, what we have to assess is what must still work tomorrow morning. What we are going to do is keep the company or the group alive. Because when a situation becomes distressed, you cannot fix, okay, maybe a 10 years of question or 20 years of the government history or 30 years of the problem in a week. Okay, So we first identify what is critical. We normally look at the organization through some questions like, for the first, do we have the real condition? Okay, where's the cash? What is the cash position? Okay, the intercompany transactions. Okay, what amount is going to overdue? Okay, or what activity are still generating cash, which means might be there's a potential of generating profit. Okay, and what communications are coming up. Okay, this is the direction question. Before deciding where to go, we need to honest picture of where we are. Okay, the second, are knowledge and authority connected? Okay, in this case, in actually many of the cases, the founder had the authority. Many of the cases are actually the founder-led firms. The accounts had enormous amount of the institutional knowledge, okay, which means many of the knowledge are actually is intangible. Okay, the frontline employee were receiving the credit pressure. Okay, external advisor like us might have some different information, but those things were not connected through one reliable decision and escalation route. Okay, this is the integration problem. And this is what the human control surface become very visible. Okay, we are talking the human control surface, which means the behavior and the culture itself, okay, should become governable and controllable. Which the formal system is weak. The organization start depending on habit, loyalty, informal authority, and the individual judgment. Sometimes that works for years until they finally fail. And the third one is, do we actually have the capability to restructure? Okay, this company, they know they are running restaurant. Maybe for other firms, they are writing garments. Okay, this is not the same knowing how to restructuring a group. Suddenly, you need entity level cash visibility, credit mapping, reconciliation, okay, legal consequences and the consideration, the stakeholder communications, action tracking, and evidence under several time pressure. The people will not, if they are not incapable, that create substantial issues. The organization has maybe simply never built that collective capabilities. So, because normally the operations are running smooth under maybe a comparatively static model, when we are talking about the restructuring, it's more dynamic. So even many of the business school, they are not focusing enough on this part of the education. For the fourth one, what could disappear if one person disappears? This is the continuity question, and we talked before is the dependency issue as well. If the finance head leaves tomorrow, what will disappear with her? If the founder is suddenly unavailable, which is very common globally, what commercial judgment, relationship, or approval knowledge could disappear immediately? When the supply relationship exists only because one person has known somebody for 20 years, or the supplier, the most important supplier, suddenly stop supply all the information, for example, or the manufacturing raw material, what could you do? This is the key person dependency become institutional risk. And I want to stress this point. The finance head is not a human race. Okay? The responsibility without authority, knowledge without transfer, dependency without backup plans, and loyalty without a protected challenge route create the human risk issue. So the immediate human governance risk map for me was quite simple. Okay, here we talk about the human governance risk map. Okay, we would like to map the critical people and roles, the knowledge that cannot be lost, because we have the knowledge to operate the firms. Who can design? Who can escalate? And which operation must continue? Which people are carrying a managed pressure? Because under the restructuring, the pressure is completely different from a static status. So the pressure is coming from the supplier, from your bosses, from everywhere. And what need to stabilize just now? Then give every material action an owner and a review point. It's not a 100-page restructuring manual. That's useless. No one is referring to a restructuring manual during the critical situation. One usable picture tells us what matter, who owns it, what happened next. You have to create the connections. So, Davey, that is where I think the HR earned an important real seat in the restructuring conversation, not by taking over finance or legal work, but by making the human dependency, risk, visible early enough to act on them and let every stakeholder know.
Yeah, so I think there's an Asia specific dimension to how organizations choose the path forward from here. So what should this room be holding on to? So I think in Asia, the choice of procedural architecture itself is a structural HR decision. So yes, especially in Hong Kong scheme of arrangement, a Singapore co-supervised structuring, a Japanese civil rehabilitation, and also a mainland China bankruptcy reorganization. Each has, I think, different bench muscles and also the exposed different weaknesses. So choosing between them isn't solely a legal or bank call, it is a board decision. And HR seat at the table should be structural, not advisory. They are very important because HR is only function position to see whether the chosen procedure will hide the bench true weaknesses or to expose them safely. So I've got a minor question. I will leave the room before our Q&A session starts. So who in your organization right now is the equivalent of that accounting person that has been working in the company for over 20 years, trusted with everything, empowered with nothing? So a restructuring will always find them. The only real choice is whether you find them first or they find you first. Okay, so thanks very much, and we are going to take some Q&A. So we've got 2 questions from the chat, from a comment, and the first question from a LinkedIn user is, how should organizations learn from crisis after the immediate pressure is over? So maybe I can take this question first. Okay, Anthony, if you don't mind. So there's thanks for the question. It is very good question about like how do you handle pressure at the same time. So I think a crisis strips that disguise away. And hang on. Can you hear me? Okay. So I think a crisis strips that disguise away, and it does it fast. So first, it reveals the real decision maps versus the paper one. In the Hong Kong F&B group, our case, nothing meaningful ever moved without the founder. So no matter what the job title says, whether you're CFO, CEO, CHRO, that was always true. So the creditors arrive all at once, simply make it impossible to keep penetrating otherwise. And second, it reveals whether your culture runs on compliance or genuine ownership. Okay, so compliance follows the process and stops exactly where the process ends. And ownership produces efforts when nobody is watching. And you genuinely cannot tell the 2 parts until the pressure hits. Third, and most relevant to everyone in HR, it reveals whether your people system were built for reality or for the comfortable story that you told yourself about your own talent. Okay, pay bands or promotion criteria performance reviews are calibrated for calm water and nothing else. So when the situation is fine and everyone is happy, but what about if the water is choppy? So the accounting head in the F&B group in our case was still paid for a job description written 20 years ago and never once revisit. So either he or she is called the CEO or CFO or accounting finance manager or whatever. So a crisis didn't create that gap. I mean, so it just removed the conditions that let it stays hidden. So that's my answer to the question.
Okay, my answer is that after the restructuring, logically the firm is renewed. So actually, it's the time to review and actually to see if the firms could learn anything from the crisis. The learning mechanism is important to feedback to the firm, especially from the top, upper management to the bottom. So everyone should learn the part all together to see the future path of the firms. Also, it's the time to rebuild the capability. So normally after the recovery renewal, so the firm doesn't mean back to normal status. Okay, in Chinese it's time for 股本回原. Okay, that means you are not healthy actually, but you are just step out from the hospital only. So it's time to rebuild the capability. You have better control on the cash flow, better control on the dependency, and in fact everything. You have to build up your GSE strategy from the bottom together and see if the behavior and the culture has substantially changed afterwards. Actually, there might be some repetitive behavior keep repeating from appearing and appearing after the restructuring. So you have to be aware of institutional genes over here. So the genes itself could be good or bad, but for bad, we have to think of a solution to make this change. So there's another question. Let me show on the board. Okay, this is from what can a crisis reveal about an organization's culture that normal operations hide? Davey, would you like to go first?
Yep. Thanks for the question. So how can organizations learn from a crisis rather than immediate pressure is over? So I think from my personal point, the dangerous move after surviving a crisis is breathing a sign of a relief and going back to business as usual. Because business as usual is usually what caused that in the first place, right? So real learning takes a few deliberate steps. So imagine you're learning something, you've got to learn the same thing again and again to memorize, to consolidate your knowledge. So capture the knowledge is quite fast. The people closest to a crisis who saw exactly where the decisions right or information failed are often the first to leave once the pressure lifts. Okay, so if their knowledge isn't documented before they go, the learning leave with them. So imagine it is a very common case that if you get a very good salesperson in a company and they control most of like 80% of the sales in your company, and at the same time they feel the pressure, they stand up, they leave the room, and 80% of the business leave with that person. So at the same time, if you own almost maybe like the entire system and knowledge, for example, the accountant who has been working for a company for 20 years in this case, when the person stands up, leave the room, your company is basically empty with no knowledge. Everything is not documented because they have been working like throughout the day by day. Everything is inside the head. So if there is no structural review, not just a narrative one, and most Motem stops at here is what's happened, which helps people to process it emotionally but change nothing. Because it's never asked why the decisions rights were unclear, or when hiring and pay decisions produce and the capabilities gaps that you saw. So test the fix. So test the fix rather than just designing it. A new escalation chart looks like a great on paper, but the only real test is whether the actual people involved could make the same call. Okay, so under the same time pressure, for example, tomorrow, and finds whoever saw the problem first, a supplier chasing an early payment, a manager noticed a withdrawal that didn't add up, and ask them, okay, what stops that information traveling upwards sooner? The answer is a precise map of exactly where your system failed, hand to you for free. Okay, so lying to carry out, the most expensive thing in an organization can do after a crisis is survival it without learning from it. Okay, to live with it, to survive with it, rather than to learn from it. Because the next one will find exactly the same weakness if you don't have documentation.
Okay, thank you, Davey. I think a firm could survive just a crisis. That doesn't mean they could survive another crisis. So the learning process is very important. But back to the first crisis, that reveal maybe a lot of the issues. Maybe they have maybe for the firm like 3 to 5 years ago, they might have the capability to handle such crisis. So normally crisis doesn't blow out suddenly without telling you, and that must be subtly developing already. So from a healthy company to be unhealthy, that's a progress itself. It's like uh, the rat and my dad, they slowly eat the tree, the center of the tree, and finally the tree fall down after a storm. So everyone might find out that it's hollow inside. So it's structurally sound from the appearance. That doesn't mean you have the capability in the long run. So everyone should be aware this change, and then with the external factor that might just make the crisis coming faster than expected. This is what I would like to share with you guys today. So, any takeaway for our audience for today, Davey? Okay.
Hello, can you hear me? Okay. So my takeaway will be first one is restructuring is a stress test, and you only get one chance to grade the result. And the cheapest restructuring is always the one you run on your own timetable by mapping your vulnerabilities before a creditors or court or a market force you to. And the second takeaway would be the HR first deliverable in any workout, or better, months before one. It's the human governance stress map. So built using my three lenses. So who decides, who owns the consequence, and can the bench execute? So three lenses. So these are my two takeaways.
Okay, for my two takeaways. Okay, the first one is stabilization is a human capital governance priority. Okay, protect the critical people, knowledge, authority, and escalation capacity, not just about cash and operations. The second one will be human risk can determine whether restructuring succeeds. Okay, responsibility without authority, key person dependency, weak challenge and unmanaged pressure can undermine even a sound restructuring plan. So this is what we discussed today, and we hope you enjoy this episode. For any comments, please just let us know on LinkedIn or other paths so you could easily locate us. So stay for next week, and Rita will be back. Thank you. Thank you.